Okay, listen up, kiddos. You need to know what a covered call is, and you need to know what a cash secured put is. If you don't know what either of those are, you don't know one or the other, you're in the wrong spot. Go watch them. They're going to pop up in the corner over here, or you can find them in the description down there. You also need to understand what it means to roll your position. And if you don't know what that means, you can find an explanation of that in the cash secured put tutorial down there. Okay, so understand what a covered call is, what a cash secured put is, and what it means to roll your position. If you understand all those things, the wheel strategy is going to be a cakewalk, I promise. The main purpose of the wheel strategy is to combine the two juicy income characteristics of a covered call and cash secured put. You put those together and you're compounding the amount of income that's coming through the door. So let's walk through the steps of trading the wheel strategy. And it'll start vague and we'll start getting into more detail as we go on. So big picture first, fellas. Step 1, sell a cash secured put. Go out there, find a stock you like. Find one that you wouldn't mind owning. And it's also pretty beneficial if it's a stock that's relatively cheap, because if you get assigned, well, then you aren't going to have to fork up as much cash. So find a stock you don't mind owning. If it's cheap, that's good. And sell a cash secured put on it. So we'll write it up here. Well, we sell a put in step 1. While we're trading the wheel strategy, we are operating under the assumption that we do not want to get assigned. We are looking to generate as much income as possible. We're looking just at the income. We don't care about owning the stock so much. We just want to get that income coming through the door. So we're going to try to avoid assignment as much as possible. That said, when you go to sell your cash secured put for the first time, you're just entering the wheel strategy, well, you're probably going to want to sell it a little bit out of the money. The further out of the money it is, the less likely you are to be assigned, because it's less likely to become in the money over time. And if it's out of the money, then at least right off the rip, you're definitely not going to get assigned, because no one's going to exercise an out of the money put. So because we're trying to avoid assignment, we want to sell a put that's pretty far out of the money. In fact, we want it to have a 70% chance of staying out of the money. To roughly estimate this, we can look at delta of an option, because delta roughly estimates the probability of an option getting in the money. So for example, here I'm looking at snap options. Let's say we want to sell a 25 strike put. If I tap on it and then tap on the bid-ask spread, here we can see the options statistics. Down at the bottom, you can see delta says minus 0.32. So roughly it has a delta of 0.3. Well, if delta represents the odds of an option being in the money, then that means this option has a 30% chance, roughly, of becoming in the money. In other words, it has a 70% chance of staying out of the money. So look for a put that has a delta of 0.3. That way, you'll most of the time not have to worry about the option becoming in the money. The odds are slim that it'll ever become in the money. So step 1, sell a cash secured put. Sell it on an underlying that you don't mind owning. Because if you get assigned, you're going to have to own it. Sell it with a 70% chance of staying out of the money. So in other words, sell it with a delta of about 0.3. And then lastly, I would choose an expiration that is 30 to 45 days out. Why? Well, here's what happens 30 to 45 days out. So on the left axis, we have, on the y-axis, we have premium, and on the x-axis, we have time. The premium stays relatively constant, assuming not very much change in the underlying stock price. But within 30 to 45 days, time decay really starts to ramp up, and so the value of an option decays off quite quickly. So as we hit 30 to 45 days till expiration, you'll see the value of an option start ramping up exponentially until at expiration it is worth 0, and if it's out of the money, it expires worthless. So we want to sell with an expiration 30 to 45 days out because we want to capitalize on the degrading value of options through theta, and it really starts to ramp up 30 to 45 days out. Remember, we're not buying options. We don't want the value of an option to increase. We want it to decrease, especially if we plan on buying to close at some point or maybe rolling our position. If the options value has decreased quite quickly, we can quickly make money, buy to close, and sell to open a new cash secured put. Step 1, sell cash secured put with an expiration with 30 to 45 days out. The probability of it being out of the money roughly equal to 70%, so a delta of roughly 0.3, and then on an underlying that we don't mind owning. Step 2, avoid assignment and roll your position. We've already started avoiding assignment by choosing an out-of-the-money put option with a 70% chance of it staying out of the money. However, over time, your put option may become in the money, and then you might want to roll that position out to a later date and a lower strike for a credit. So we have a short put, this short put up here. Okay, but over time, it might become in the money. And we don't want it to be in the money because if it's in the money, we could get assigned at any point. So to avoid this, we buy to close that put and sell to open a new one with a later expiration and a lower strike, hopefully out of the money, to avoid assignment. You should be familiar with rolling your put. So this one is now out of the money. So this would be put number 1. Okay, this is still put number 1. We're just buying to close it. And here's our second brand new put that we've opened for a credit. So you're going to keep doing this, avoiding assignment. Although sometimes it may not be possible to roll your position for a credit, or you may have to roll way out in the future in order to receive a credit and keep it out of the money. Sometimes may not be possible. It may not be possible to roll for a credit, or it may not be worth it. And by that, I mean you have to roll your position way out in the future to collect the credit, and that might not be worth it. If you're collecting a 20-cent credit on $2,500, but have to roll it out by a year, well, you're locking up $2,500 in collateral for $20 over the course of a year. That's a horrible return. So in that case, you might just let it be in the money. Over time, eventually you're going to get assigned. So either you can't roll it for a credit, or it's not worth rolling for a credit, and that's up to you to decide if it's worth rolling for a credit or not. How much credit am I getting divided by the collateral is going to be our percent return over how much time. So it's up to you to decide, like, is 1% a month good enough? Is 2% a month? You decide if it's worth it or not. Eventually, though, it won't be worth it, or you won't be able to roll it for a credit. And step 3, you're going to get assigned. When you get assigned, the put disappears, and you buy 100 shares of the underlying. This is why in step 1, we discussed that you want to be willing to hold the underlying stock. It has to be a stock that you like enough that you could hold it in hopes that it rises in value, and then you can start incurring capital gains. Now, while this isn't optimal, while we really like just selling to open puts and rolling puts and collecting as much income as possible, it's okay. This is going to happen, and it opens up a new window of opportunity for more income through covered calls. So once you get assigned, you don't have the put, you have 100 shares. There's a little bit more to this, which we'll talk about in a minute when it comes to cost basis. But for now, you're selling it out of the money, and you're selling it with around the same probability of staying out of the money, so a 0.3 delta. Step 5, avoid assignment and roll. Same idea. We sold it out of the money, so we're already starting by avoiding assignment. It can't be assigned, but it may become in the money or close to in the money, and you can start rolling it out for more credit, both to collect more income and also to avoid assignment. So in this case, you'll have a short call. It becomes in the money or close to in the money or whenever you want to roll it out for a credit, and you will buy to close that call and sell to open a new call that's out of the money for a credit. Okay, so you're avoiding and rolling. Eventually, you can't roll for a credit or it won't be worth it, and you get assigned. What happens when you get assigned for a covered call? Well, you sell 100 shares at the strike price, so you now lose the shares and you lose a call, so your position is flat. You'll have some profit and loss, which I have a spreadsheet for you to help calculate that, which I'll show you in a second. But we're going to go right back up to step 1 where we sell a cash secured put again, and we repeat the process. So at this point, you might be wondering, well, how do I know what my profit and loss is, among other things? Well, I have a spreadsheet that'll help you calculate that. We're going to go over that in just a second. But once you get assigned, you sell those 100 shares, the contract disappears. Well, guess what? Your position's flat. You can repeat the entire process. So you go right back up to step 1 and you sell cash secured put again, and you just rinse and repeat. So step 1 through 6, over and over and over again, keeping that income flying through the door. People sometimes call this the triple income strategy because you create income from selling puts, you create income from selling covered calls, and you create income because when you get assigned, you're hopefully selling the stock for a higher price than you bought it for. So you might see the wheel strategy called the triple income strategy, and that's why. Now, we've kind of discussed where you should sell calls and sell puts based on the probability of it being out of the money, but there's another thing we have to take into consideration, and that is called cost basis. I think the best way to learn what cost basis is and why it's important in the wheel strategy is by running through an example. So let's say we're not a chud. We want to trade the wheel strategy. We don't have anything open yet, but we know the first step of the wheel strategy is to sell cash secured put. So we go ahead and do that. So we sell a CSP, a cash secured put. And for doing so, hypothetically, kind of a big number, but we receive $500, which you can also, as a credit, and we can also call that $5 if we're talking in premiums terms. Okay, so $5 in premium is $500 real cash money. Let's say we just hang on to it, it becomes in the money, and we get assigned. And we'll say the strike of this was 25. So if we get assigned, we have to buy 100 shares at the strike price, which is $25 per share in this example. So in this case, we have to pay $2,500, and that's a debit to buy those 100 shares at the strike price, which is, in other words, $25 per share. And here is where we can describe our cost basis. Cost basis in simple terms is how much you actually paid for the shares. So if we received a $500 credit, but then paid a $2,500 debit to buy the shares, well, how much do those shares actually cost? If we're trading this as one strategy, we can think of it as costing $2,000. Because we had $500 come in and then $2,500 go out to buy the shares, really the cost of the shares is $2,000. The credits we receive from cash secured puts and covered calls reduce the cost of shares because we can use those funds to buy the shares, and we can consider that kind of free money. So you can also see your cost basis is $20 per share. Now, this is very important to know because this next step, we want to sell covered calls above our cost basis. So we want to sell covered calls above our cost basis if possible. Why is that? So let's say our cost basis is $20 per share, which is what we deduced up here, and we sell a covered call with a strike of 19. Now the stock price, S sub 0, might be something like 18. We sold a covered call with a strike below our cost basis, which we don't want to do, and here's why. The cost of these shares is $2,000. Okay, nothing's changed, nothing crazy. That didn't come out of nowhere. We've already mentioned this up here. That's our cost basis. But if we get assigned, we have to sell 100 shares at $19 per share. That means we pay a $2,000 debit as our cost basis, and we receive a $1,900 credit for selling those shares at the strike price of 19, and we are left with a loss of $100. Okay, so this is why we don't want to do that. We don't want to sell a covered call below our cost basis. We want to sell it above our cost basis. Whenever we sell a covered call above our cost basis and we get assigned, we are guaranteed to have a profit. Where you sell a cash secured put relative to your cost basis doesn't matter. The credits from a cash secured put is going to reduce your cost basis when you get assigned later. But you can sell cash secured puts wherever, although like I mentioned before, you probably want to sell with a roughly 70% chance of staying out of the money. Covered calls, once you are assigned, you want to use covered calls to reduce your cost basis further. Those credits are going to reduce your cost basis. As you can see, any credit right here is going to reduce the cost of assignment, but we want to also sell them above our cost basis. That way, if we get assigned, we have to sell 100 shares. We're selling 100 shares for more than we paid for them. If our cost basis in this example is $2,000, we don't want to sell a covered call below $20 per share. Remember, these are synonymous. We want to sell above $20 per share. Otherwise, we will end up getting assigned if we hold on to that covered call, and we will incur an overall loss on the position. That's not good. So sell a covered call above your cost basis. So for example, if I sold this covered call at 21 and got assigned, we would receive a $2,100, sorry for the scribbly mess, we'd receive a $2,100 credit, and this wouldn't be a $100 loss, it'd be a $100 gain. And so the real message of this whole story we're looking at here is we need to keep track of our cost basis. So we understand a cost basis is taking how much we paid for those shares when we were assigned and subtracting all the credits from all the covered calls and all the cash secured puts we've ever received. And that will be our cost basis for these shares. So to keep track of this number, what do you do? Do you write it down? Do you keep it in your head? What do you do? Your boy's got you covered. I've made a totally free spreadsheet for you guys. Don't let anybody try to sell this to you, okay? It's a totally free spreadsheet used to keep track of your credits and keep track of your debits so that you can see your adjusted cost basis, as well as your profit and loss for the overall wheel strategy that you're trading. This spreadsheet we're about to go over is totally free. Your boy made it, okay? No one else had any fingers in here. I made it. But if you want to show a little gratitude, go to the description below. There's a link that'll take you to Webull. It's a brokerage. And deposit $100. That really helps support the channel, and you'll also get a free stock as well. So you will use this spreadsheet to keep track of your credits and your debits and see what your profit loss is and your adjusted cost basis. And that's what I described to you it was our adjusted cost basis. Our cost basis, without the word adjusted before it, is just how much we paid for the shares. We are adjusting that cost based on how many credits we've received from selling cash secured puts and from selling covered calls. So we're adjusting our cost basis to more accurately reflect how much money we've put into these shares. If I paid $2,500 for 100 shares, but received a $1 credit of premium from selling a covered call, my adjusted cost basis is $2,400. So my cost basis is $2,500. Adjusted for credits, my adjusted cost basis is $2,400. And that is the cost basis, I swear I'm almost done saying that we have to keep track of to know where to sell covered calls so that we never end up in a situation where we end with a realized loss by the time we get through all of those 6 steps we discussed earlier. Speaking of, let's run through those 6 steps. Let's enter some hypothetical trades so you can see how to use this baby. What is step 1? Can anybody remember? You, donut in the front. Step 1 is sell a cash secured put. So let's do that. The action, underneath the action column, you're going to put whatever you did. We're selling a cash secured put. You can just put sell a CSP. You can just put CSP. That's what I would do. And we'll put today's date, 10/13/2020. Number of shares is how many shares are involved in a contract or when you get assigned. So in this case, with one cash secured put, we have to have enough money for 100 shares. So we're going to put 100 right here. If I had 2 cash secured puts that I was selling, I'd put 200. or 300 if they're the exact same cash secured put. So we're only going to sell one of them. So let's enter 100 here, and we'll receive a credit hypothetically of $2. The total money received is automatically entered, and you can see a number up here popped up, and this number represents either our adjusted cost basis or our running profit and loss. It represents our adjusted cost basis if we've been assigned. It represents our running profit and loss if all of our positions are closed. And you can see that to the right. Only accurately acts as profit and loss when positions are closed, and acts as a cost basis when assigned. If you do not own any shares from being assigned and you have not closed out all of your positions, this number will be relatively meaningless. So only look at it if you have been assigned to see what your cost basis is, or look at it once all your positions are closed, once you reach step number 6 to see what your total profit and loss is so far. So right now it doesn't mean a whole lot to us. So step 1, sell cash secured put. Step 2, avoid assignment and roll your position. So after selling this cash secured put, some time goes on, and let's say it gets in the money and we don't want to get assigned. And if we're going to avoid assignment, we want to roll down and out. We want to roll down in strike and out in expiration for a credit to avoid assignment and to collect some more premium. So this side over here on the left is our credits. So we entered our credit for selling cash secured put, but now we're going to buy to close this put and sell to open a new one. So let's go ahead and buy to close this position. So we'll put close here. And over here on debits, we're going to enter how much we paid to buy this put back. So I'll put buy to close CSP. You can put whatever you want, whatever makes the most sense to you. And we'll say it's a few days from now. For shares. And we'll say because it's become in the money, it is now worth more than we sold it for. So we're going to end up paying more than we sold it for. So let's say we pay a debit of $2.50 instead of $2. So you can see we sold it for $2. Here we bought it for $2.50. Now before we continue rolling this put, you can see now that our position is totally flat, we sold to open and then we bought to close this put. You can see our status is closed. We can take a look in the top right and see what our running profit and loss is. In this case, so far our profit and loss is minus $50. But we're not done, are we? So we don't have to worry about that number so much. So the last step in rolling our position is selling to open a new one, rolling it down and out. So we'll do another cash secured put. We'll be rolling it on the same day, so it'll be October 15th. We'll do it for 100, and we'll roll it for a credit of $3. And we can put open here. Okay, so we've done step 1, which is sell a cash secured put. That is this row right here. We've done step 2, which is avoid assignment and roll your position, which is this row and this row. Step 3. At some point, it may not be worth to continue rolling your position because you're just not getting enough credit for how much collateral you have locked up. Collateral being the strike times 100. You have to have enough money to buy those 100 shares. Robinhood or whatever brokerage you use is going to set that money aside. And if I'm locking up $2,500 for a 20-cent credit over the course of 7 months, it expires in 7 months before I collect all that 20 cents. Well, that's not really worth it to me. In that case, I might just leave it in the money and just wait for assignment, or maybe you don't even mean to, you just end up in the money and you get assigned. Either way, we hit step number 3, which is get assigned. When you get assigned a cash secured put, what happens? If you remember, with a cash secured put, you buy 100 shares at the strike price. If you're paying money, any money going out the door, you're paying a debit. Any money coming in the door is a credit. So when you get assigned, this put is going to disappear, so we'll put closed. And we're going to pay a debit to buy 100 shares at the strike price automatically. So it'll say assigned cash secured put. We can say it's on October 25th, hypothetically. And we're going to be buying 100 shares. And instead of entering the total debit, we're going to put share price. If you look up here, it says debit or share price. When we're assigned, we're going to enter our share price. Let's say hypothetically it's $25. And total paid will automatically be entered. Now we can see our adjusted cost basis. Remember, I said this number up here to the right, the one that's red right now, is our adjusted cost basis if we've been assigned, or it's our profit and loss if all our positions are closed. If neither of those criteria have been filled, then that number up there is relatively meaningless. But you can see it is now our adjusted cost basis because we've been assigned. So now you can see the benefit of the wheel strategy so far. We've collected some money, and we've also reduced the cost of these shares. So these shares cost $2,500. Well, not really anymore because we collected some credit in selling a cash secured put and avoiding assignment and rolling the position. So now the adjusted cost is $2,250. So theoretically, we didn't really buy at $25 a share, which $2,500 would imply. We bought at $2,250 per share. This number is very important to know because if we do not sell a covered call with a strike above our cost basis, we will end with a realized loss by the time we hit step 6. By the time our position is totally flat and we've gone through one cycle of the wheel, That's why it's called the wheel, is because you keep repeating those 6 steps over and over. So if we sell a covered call above our cost basis and we get assigned at some point, great, because we're going to end with a realized loss if we get assigned. So let's go ahead and sell a covered call above our cost basis. So next step number 4, sell a covered call. So over here, when we're selling any sort of option, when we're selling to open, we're going to collect a credit. So we're going over here to our credit section, and we'll put covered call. We'll say we'll open it the day we get assigned. So that'll be 10/25/2020. We're only going to open one of them, and we'll receive a hypothetical credit of $1 even. The strike of this covered call that's not shown here has to be above 2150. So we could sell it for 22, 23, 24, 25, anything above 2150. Maybe with the same delta as I mentioned before, it should be 0.3 to make sure it has roughly a 70% chance of staying out of the money. Now, the reason I say 0.3 delta, not anything else, is because if it's below a 0.3 delta, you have a below 70% chance of staying out of the money. You may get assigned more likely than you'll be happy with. The reason you don't go past a 0.3 delta is because you start reducing the amount of premium you're receiving without much benefit to the probability of staying out of the money. So yeah, if you sell it with a 0.2 delta, you'll have an 80% chance of staying out of the money, but you're going to be reducing your premium substantially to the point where it's probably not worth it. So you have to analyze it, look at it. 0.3 is a nice general rule of thumb, but also make sure that you're happy with the credit you're receiving. The most important part you have to remember is selling above your cost basis. That way you can always end with a realized loss or profit and not a realized loss. So don't fixate too much on the 0.3. It's just a good guide to avoid assignment, but still collect a decent amount of premium. Okay, so we sold a covered call above our cost basis. You can't see what the strike is, okay? We're just hypothetically saying it's somewhere like 23, 24, 25, around there. We'll say it's 24. Step 4, sell a covered call. Great, we did it. Check. Let's move on. Step 5. Similar to before, avoid assignment and roll your position. So if this covered call becomes in the money, we could get assigned, and that's fine because we sold above our cost basis. But let's say we don't want to get assigned. We'd much prefer to keep rolling this out and collect more premium if possible. Keep that income coming through the door. So we're going to go ahead and roll this position once it gets in the money or close to in the money. So we're going to buy to close this. When we buy to close an option, that means we're paying money. Money's going out the door. If money's going out the door, we're paying a debit. So that means we have to fill this out in our debit section. So we'll buy to close our covered call. Let's say it's the 31st, 100. And because it's in the money, it's become more valuable. It's going to be worth more than we sold it for. So we're going to have to pay more than we sold it for to close this position. And let's say it's worth $2 now. So we're going to pay $2. And the second part of rolling your covered call is selling to open one with a lower strike and further out expiration. So we're rolling down and out. So we're selling a new covered call, and we'll do it on the same day where we bought to close it. 100 shares and a credit of $250. And we'll say this is open. Now that we've sold a new covered call, you can see as we sold this covered call, we reduced our cost basis even further. As we rolled it out for even a higher credit, we reduced our cost basis even further. Eventually, you could get to the point where the cost basis, if you get assigned, is 0, and then you're owning 100 shares for free, which is super cool. Okay, things go on, and you might decide that the credit's not worth it. You roll it out. You have to roll it out way in the future, way down in strike for maybe not much premium, or you just don't want to lock up your money for that long, so you just let your option get in the money. It could expire worthless. That's totally possible. So it's not like you always get assigned. You may have to reopen a cash secured put or a covered call if it expires worthless and you want to keep this wheel going. But most of the time, before it expires worthless, you're going to be rolling it. And if you can't roll it, well, it might expire worthless or it becomes in the money and you get assigned. So in other words, there's 3 possible things that can happen. Your covered call or cash secured put expires worthless. Fine. If you want to keep doing this wonderful wheel that you got going, just sell to open a new one. Or you might decide it's not worth rolling because the credit's not very good, and you just let it become in the money and you get assigned. Or last would be you're not paying attention, it becomes in the money and you get assigned. So we're going to say you get assigned in this case because that's generally what's going to happen. Most of the time you're not going to be holding to expiration. It's just not usually worth it. You can collect more premium by rolling it once you get pretty close to expiration, or if it gets really far to the money and is worth like a penny and you got a month till expiration, why hold it for just to collect one more dollar? You might as well roll your position. Maybe even bring your strike closer to at the money to collect more premium. So don't be afraid if, I know I'm going a little bit of a tangent here, don't be afraid if your option becomes worth like a penny and you have like a month till expiration. Don't be afraid to buy to close that. No big deal. Buy to close that. Open a new one with either a later expiration or lower strike to collect more money, to sell it for a higher premium. Because if you just roll it with the same strike, it might, if a few months out, it might only be worth $20. Bring down the strike if your delta is something like 0.05. That's ridiculous. So while I'm giving you a nice stencil to follow, you have to think logically about what's happening and decide in deciding what to do with your positions. Okay, so let's say this covered call becomes in the money. Okay, so we're on step 5. This covered call, we're going to get assigned. This covered call gets in the money, and we do get assigned either at expiration or maybe it becomes. And when we get assigned a covered call, we are selling the shares. We're not buying shares like we did when we got assigned a cash secured put. When we get assigned a covered call, we are selling the shares. When we sell shares, we receive money. Money is coming in through the door, so that means we receive a credit. So we have to enter this on the credit side of things. So we'll say covered call assignment. And we'll say this happens on November 15th, 2020. 100 shares is how much we're buying or selling, at a price of, I think I said we set the strike as 26 hypothetically. So we'll say we are selling for $26 per share. We're on step 6. We have gotten assigned. We've completed one entire cycle through the wheel strategy. All our positions are closed, and now we can see what our profit and loss is here. We've made $500 by doing this. So like I said before, this number up here acts as adjusted cost basis if you've been assigned, if you are holding shares, and it acts as a running profit and loss if all your positions are closed. This number down here is only valid if you have been assigned. So you can see that here, only valid if you have been assigned stock position. So these two numbers have some strings attached. So be sure to read the text to the right of these numbers to make sure that they actually mean something. At this point in time, what do? We've gone through 1, 2, 3, 4, 5, 6. What do? We go right back up to the top. We sell a cash secured put. It doesn't matter relative to our cost basis where we sell this cash secured put, so we can sell it wherever we like. Maybe around where there's a 0.3 delta, maybe with a little bit high implied volatility to collect more premium, or maybe we're feeling like taking a little bit of a gamble and we don't want to sell so far out of the money that has a 0.3 delta. Maybe you want to do like a 0.5 or 0.6. And yeah, maybe it's more likely it'll get assigned and we'll have to deal with things, maybe not collect as much premium. But if it does stay out of the money, we get to collect a larger credit, because the closer to at the money or closer in the money an option is, the more valuable it is, the more premium it has. So we'd start right back over. We'd sell a cash secured put right here and repeat the cycle that started here. It started right on the green row there, and it ends when your covered call gets assigned and you close your stock position right here. That's it, boys. You follow steps 1 through 6. Use some logical reasoning in deciding, well, maybe I just buy to close this position. I'll feel things out a little bit. Or maybe I roll down and strike because expiration is a month away and it's only worth a penny. We want to collect more premium than that. We don't want to have to wait a month for a penny. So roll it down and strike. Just keep that covered call above your cost basis, if at all possible. This one's really fun because it's really, once you get this little Rubik's Cube nerdy algorithmic structure going and flow going, it becomes very easy to manage these positions and avoid any situation where you're uncomfortable or you end with a realized loss. Be sure to sell the cash secured puts on stock that you don't mind owning. Be sure to sell covered calls above your cost basis if at all possible, and just have fun with it. Okay, if you want your free copy of the spreadsheet, it is down below in the description. I'll have an Excel version as well as a Google Sheets version. Go to the description, click on the Webull link, sign up, deposit $100. It is the best way to support the channel besides just watching this content. I hope you found this lesson helpful. I had a good time with you. I hope you had a good time with me. I'll catch you later.